It is time for another episode of You Ask and I Answer. And to get in the mood for the holidays, we got the red and green lights going on. Yeah. Before we get started, I do have a quick announcement. I'll be releasing a new tax update video for 2021. I'm working on it currently. I hope to have it up either right before the end of this year or the first Sunday, which would be, I believe, is January 3rd of 2021 for that tax update. So stay tuned. I'm going to have a free spreadsheet that goes along with that, and it'll be my fourth year. Can't believe it. Fourth year of doing that. So stay tuned for that. Remember to be subscribed to the channel for our weekly videos on finances, investing, and taxes. And of course, your support means a lot to me, guys. So if you drop a like, that would really help out the channel. Let's dive into your questions. Kicking things off, we have a question from Carrie Armstrong. They say, I bought a duplex in the beginning of 2019, living in one side, renting the other side out. Does TurboTax or some other have a rental program to help me do my taxes and get all my deductions and depreciation? Carrie, thank you for asking that. I actually get a lot of questions around TurboTax on the channel. Now, the thing with TurboTax, it's just like any other software program. It has its limitations. I think TurboTax has done a great deal to help each and every one of us who uses it to do our taxes on our own, but there's a lot the program still leaves out. The output of TurboTax, it's only as good as your inputs. So it's all based on what you put into it. That means, so for your rental property business, it's a little bit more complicated than just having a simple W-2. You have to do accounting. You have to have good records. You want to have that all figured out. And I can tell this person, they've checked out my video on rental property taxes, so that should help them get their accounting more in line. But in terms of depreciation and deductions, that's really something you got to know. You have to have some basic knowledge of how that works. TurboTax, I haven't used the program in quite some time. They might be able to help guide you a little bit in that area, but you definitely want to check out the depreciation publications or contact somebody who knows what they're talking about with depreciation, because unfortunately, the software, it's not going to cut it. It's not always going to know to do that for you, and the software is not going to understand your unique life circumstances. The only way it's going to do that is if all of your accounting data and all of your information is correctly presented when you're inputting it into the software. If it's not, then it's not going to give you the right result, which is why when a new client comes in who used to do their taxes through TurboTax, they often miss a lot of deductions, or they're not doing things correctly. It's very common. I know 99% of people plus are not accountants, so don't beat yourself up. But just know that the software has limitations. They do have their support. I know you can call and contact a live accountant or live CPA. You can definitely reach out to some of them. It's going to cost you, of course, but they know their software has limitations, which is why they have these professionals in place. And they are real CPAs. I knew somebody who actually worked for TurboTax doing that part-time. But it's only, like I said, that's going to cost you additional money. So you want to have some basic knowledge of how this stuff works if the software is going to work in the way it's intended for you. Next, we have a question from Jim Hurst. And I want to point this out because Jim asks, where do we submit questions? I'm a total new to investing. So if you guys ever have a question, whether it's taxes or investing, the best way for me to see it is to leave a question or comment on my most recent video. That way, I will see it. If you send it to my email, mkchip123@gmail.com, I might not see it. I have over 2,000 emails in that inbox. And I just don't have the kind of time to go filter through all of that with my day job, unfortunately, and then trying to create new content, trying to respond to you guys. So definitely the best way to leave me a question is on the video itself, because that way YouTube's going to notify me, or more likely to notify me, that you've left your comment. And if I see it and I have time to respond, I certainly will. So Jim, thank you for asking that. Next, we have a comment from Mike Wong. Mike, thank you so much for leaving this comment. He said, and this is in regards to vehicle tax deductions when buying a vehicle for business. And that's the video he watched that I produced and that I want to comment on. And Mike says, thanks for the info. Just remember that your revenue needs to be high enough to offset the deduction. In this economy, cash flow is key, and cash will remain king for the foreseeable future. buying a high cost asset just for the tax deduction isn't a prudent move. And absolutely right, Mike, it is not a prudent move. What I see a lot of people do, and whether they're trying to buy a car for business or they're trying to buy something else, is I always recommend to clients, don't buy something for a tax deduction purpose. That's the wrong play. Only buy something for your business or for whatever area of your taxes in. Don't spend money unless you actually want it or actually do need it for your business or for whatever you're trying to accomplish. Because essentially what you're doing, if you're buying something just for a tax deduction, is you're saving 30 cents, but you're spending a whole dollar to save 30 cents. So you're still going to have more cash if you just don't buy it and just pay the tax to begin with. I know people don't like paying tax, but sometimes you don't need a new vehicle. Sometimes you just don't need equipment. So keep that in mind. Never spend a dollar to save a quarter. Now this comment is from Jark02, and I really appreciate you, Jark, leaving this comment. And the unique thing about Jark, ladies and gentlemen, is he actually does work for the Internal Revenue Service. So he knows what he's talking about. He says, I work for the IRS. He says, the IRS does not think of ways to tax the daylights out of people. They cannot arbitrarily implement tax code. Congress sets tax law. Congress, not the IRS. The IRS, however, is responsible for collecting revenue for the government, and as a result, has to determine what is taxable income and what is not taxable income. In other words, they look at these laws and try to determine if it is taxable or not. Congress ultimately has to clarify the law. Whatever tax codes people deal with now were not created by the IRS, but by Congress and signed into law by the president. The IRS is not part of the administrative state that creates its own rules and laws. I can see how people may think this happens because other agencies do this, such as the ATF and EPA. So Jark, thank you so much for that comment. And just remember, guys, if you're paying income taxes, those laws are created by Congress and signed off by whoever the current president is. And the IRS is just enforcing what Congress has put together, and they're trying to just enforce it and interpret it the way Congress has intended. Next, we have a question from Joshua, and Joshua asks, when do I pay taxes on investments? He says, when you sell stocks, do they automatically tax and take out their percentage, or do you have to come up with the money and pay it back out of your own pocket? Well, I can tell you this, Joshua, when you sell a stock, the brokerage company has no clue what your tax situation is. And so therefore, they do not hold back a certain percentage for taxes. They might have a feature where you can tell them how much to withhold for taxes. I know you can specify if you want taxes withheld on dividends or with interest. I don't know if that's true for stock sales. The general rule of thumb is that you're probably going to have to come up with your own tax calculation on those investments, pay taxes on your investment sales with estimated tax payments, or more likely than not, for most people, they will pay taxes on those investments when they go to file their taxes in 2021. So if you sold investments in 2020, and let's say you had $5,000 in capital gains in 2020, let's just say they're long-term capital gains. So in 2021, when you're filing your taxes for 2020, you're going to be reporting all of those capital gains on your tax return. And when you do, it's going to calculate how much tax you owe. And if you don't have enough withholdings from your wages, I'm assuming you are a normal employee, or withholdings or estimated payments from other sources, then to cover your investment tax gains, then you're going to have to pay whatever amount of taxes left over when you file your return and pay that by April 15th. If you want to pay it sooner, then you would do that using estimated tax payments that you can utilize. And I have several videos on the channel that cover how estimated tax payment works. Next, we have a comment from CPA Career Pass, and they say, in public accounting, you may have a low salary at the associate level. However, you will learn so much more than in private accounting. I absolutely agree. So for those of you who are thinking of seeking a career in accounting or eventually becoming a CPA, the starting salary is pretty low. But the thing with public accounting, where you're working with individuals who have different businesses, different life circumstances, they might have trusts, you might be working with nonprofit organizations, you're going to get such a wide array of experience. You're going to know so much about so many different industries once you've been doing the job for a few years. You're going to be very valuable as an employee if you're looking for another job. If you want to move into the private sector, it's really a lot easier once you have that background. And I've seen a lot of accountants transition to, CFOs eventually, or controllers. I mean, that's more rare, but it definitely can happen the more experience you have. Or right into a accounting management type of position right out of a public accounting firm. So there's a lot of career path opportunities available for you. And I wanted to mention this because I do have a lot of people who reach out to me asking me questions about getting a career in accounting. Now, at my level, I'm a senior tax manager at the firm where I currently work, and that has been a good experience for me. I really do enjoy the work, and it's a lot of fun. And I've been doing this for about 10 years now. So the pay definitely improves the longer you've been doing it and as you've reached those higher levels. But, always think about what do you want to do. But I think if you want to get a good set of experience like no other, and you're in accounting, starting in public practice is probably the fastest way to gain that experience. And you're going to have recruiters contacting you for job opportunities left and right once they know you're working, because there is such a shortage. At least where I live in California, there is a tremendous shortage of people with experience in accounting, and you're in high demand. Yeah, even during COVID, you're probably even in more demand, to be honest. This question is from Martin. Martin says, let's say I have two houses. One I can sell in early 2021 for a possible profit of $150,000. The second unit I currently live in for the past year. I moved out of the first one in October of 2019 and can possibly sell for a profit of about $25,000 to $30,000. How would you go about these sales to pay less taxes to Uncle Sam as much as possible, is what Martin's trying to say here. All right, Martin, great questions. So it sounds like that you're using one of these properties to live in and the other one is an investment, or maybe they're both investments. I can't fully tell, but if you want to avoid tax on real estate, the best way to do it, especially like a situation like this where you want to eventually just sell it for a profit, is to live in it long enough so you get that personal revenue, or the personal residence exemption, which falls under IRC code section 121. And that's going to break out the rules for you on that. But essentially, you'll want to have lived in that property at least 2 out of the last 5 years and treat it as a personal residence. There's some other rules that go along with that, so that's why you should look that up. Personal residence exemption rules. And the personal residence exemption, what that does is if you file single on your taxes, you can exempt up to $250,000 in capital gains, which is the amount above your cost basis, the amount you sell it for above your cost basis, and pay zero tax. Now, if you're a married filing joint filer, you can actually exempt gains up to $500,000. So if you were to, I would say, if you don't want to sell it yet, if you don't mind living there and you don't need to move out, I would live there a little bit longer in that one property so that you can at least get that personal residence exemption before you move out of it, because it might be well worth your while tax-wise. The other thing you can do is depending upon the nature of the property. So if these are strictly investment properties, to avoid paying tax, you can roll it in to another property, a better property. So what a lot of people do is they use the monopoly formula. Robert Kiyosaki talks a lot about this, is where you have like 4, let's say, single story homes, or 4 single family homes is what I'm trying to say. And you do a like kind of exchange into like an apartment building, or to a duplex or triplex or something like that. Something more lucrative from a rental standpoint. But you can use a like kind of exchange as well. So that's another option. Those are just 2 easy things you can do. The third thing you can do, which is a no-brainer, is make sure you spread out the tax. So if you do want to sell them, and let's say you need to move out of your current place right now, regardless, and you still want to sell them, well, then I would maybe just sell one at a time. So sell one in 1 year and sell the next one in another year. That way you're keeping your overall taxable income and your AGI down as much as possible. So you're spreading out that gain over a longer period of time. And so with that, you have more room to do tax planning and figure out how to shave off any capital gains you might pay on that investment, or where you can take deductions and other areas of your return if you give yourself time to plan that out. So definitely, you can live in it longer to try to get the personal residence exemption on one of the units. You can think about doing a like-kind exchange, or thirdly, you can spread out the capital gains by selling one in 1 year and waiting another year to sell the other one. All right, those are just some ideas. Hope that helps. That is going to bring this Q&A video, ladies and gentlemen, to a close. Thank you for all of your engagement. Your comments mean a lot to me. They really do. And I've had a lot of fun making this video. And thank you once again for 60,000 plus subscribers, helping the community hit that goal before the end of this year. Wherever you're located across the country or across the world, Merry Christmas and Happy Holidays.